Hi, before this video, you should already understand the words and concepts found in financial statements. So these financial statements are the balance sheet and the income statement. You should have also already watched my other free video on the current ratio. Alright, so remember, the topic for this video is the cash ratio, which is one of the liquidity ratios. Remember, you can always go back to mbabullshit.com. Alright, so this video discusses and analyzes the cash ratio, which is one of my free videos on liquidity, profitability, and market value ratios, which include these ratios over here. Okay? And after this, you can check out my next videos on mbabullshit.com on financial leverage, which include this, and on turnover ratios, which include this. Alright, so let's get down to it. So let's start with a story. Let's say that ABC Company has $200 in cash and $800 in current liabilities. What is its cash ratio? Very simple. It is simply 200 divided by 800. Okay, so what is the where did we get the 200? It is the $200 in cash. 800 is the $800 in current liabilities, not all liabilities. Now you notice up here we only input the cash amount and not all of the current assets of the company. Okay, so basically, what does this mean? What will our cash ratio be? Very simple. It will be 0.25. So it's similar to the current ratio, but we only compare cash with current liabilities instead of all current assets to current liabilities. Why? Because you can easily use all current assets. You cannot easily use all of your current assets to pay for your debts, right? But you can pay all your debts with cash right now. So you can use this cash right now to pay all of these current debts right now. Okay? So that's the importance of it. So what does this mean? What does our 0.25 cash ratio mean? It means that the company has 25% the amount of cash right now to pay for its liabilities due within the next 12 months. Okay, remember, liabilities due within the next 12 months is called our current liabilities. Alright. Or another way, the company has enough cash to pay for 25% of all liabilities due within the next 12 months. So this indicates, now it only indicates because I use the word indicate because it's not 100% sure. It indicates that the company will not have any trouble paying 25% of its debt for the next 12 months. The cash of the company is more than enough, okay? It's just enough to pay for 25% of the current liabilities for the next 12 months. So this 20, I should have a 25% over here. Anyway, not more than. Okay, not more than. Okay. All right. So if the cash ratio is high, why is this good? Well, it's good for creditors, such as banks, which loan money to the company, which need to be paid back within the next 12 months. This indicates that they can easily get paid back. If the cash ratio is high, why is this bad? It may indicate inefficiency in using cash. Why? Well, think about it. If you're a stockholder or a shareholder or owner of a company, you want ABC Company to earn you profit using as little cash as reasonably possible. If there's excess cash, you'll want ABC Company to either give you back that cash as the owner because the company isn't using it anyway, or you would want the company to invest it in other projects to earn more profit for the company. Okay. This could also signal, now if you have a high cash ratio, this could also signal inability of the company to expand or to grow, or that the company is stagnating, meaning it's stopped its growth. Why? Because if a company can expand, let's say for example it's a fast food company. If the company has excess cash, why don't they use that cash to put up more branches of the restaurants, of the fast food restaurants, so that it can earn more money? Maybe the company is not able to set up more branches because there's not enough demand for your product anymore. There's not enough, maybe the market is saturated, meaning you have too many branches which are already open, for example, like what some people say is the case of Starbucks, right? Some people are claiming that Starbucks overexpanded, or Krispy Kreme overexpanded, some people say, and because of that they could not open up any more branches. Okay, so because they opened too many branches already and there was not enough customers to buy from the new branches anymore. So if your company has too much cash, or your company has a high cash ratio, why does it have such a high cash ratio? Maybe it's because you're no longer able to expand your business anymore. So you're stuck with cash instead of using that cash to grow your company. Okay, so again, so it could signal inability to expand or grow, or the company's stagnation. Now the opposite is also true. If the cash ratio is low, this could be bad. Well, it's bad for creditors. Okay, maybe banks which loan them money, which need to get paid back within the next 12 months, the company might not have enough cash to pay them. Okay, if the cash ratio is low, why is this good? It could indicate efficiency in using cash. Okay, why? Because if you're a stockholder or a shareholder or owner, you want ABC company to earn you profit using as little cash as reasonably possible. Okay, or maybe because your company is growing so fast, every time you make a profit or every time you have extra cash inflow to the company, you use it to set up more branches because there's just such strong demand for your products. So it could indicate quick growth as well. Okay, good growth. So it could be good as well if your cash ratio is low. So the important thing is to always find out why. The cash ratio was low, why? The cash ratio was high, why? Okay, so you cannot make a conclusion based on the ratio alone. Okay, so what are the flaws of using this ratio? Well, one is that a high cash ratio may give a false sense of optimism to creditors who are not looking at the nature of the cash. So for example, your company has a high cash ratio because it has a lot of cash. And why does it have a lot of cash? Because it has huge bank loans with expensive interest. So it has a lot of cash because it borrowed the cash from banks. Okay? But in this case, what if it borrowed a lot of cash from banks, is paying a lot of expensive interest, and the company should be using this cash for profitable projects, but it's not. Okay? What's going to happen is you're not earning much money in profit, but your company will have to pay a lot of expensive interest because of this cash that it's borrowing. Okay? Okay, now, you may not have enough cash to, or you may have enough cash to pay short-term debts, okay, but these expensive loans will have a strong negative impact on profitability because of the expensive interest. So this is bad for longer-term creditors. Meaning, what if the bank, your company or this company has a lot of cash because of long-term loans which are payable within 10 years, for example. Okay, 10 years. Okay? if the company has a lot of cash because of long-term loans which are payable in 10 years, then it will have enough cash to pay the short-term debts. And remember, in computing the cash ratio, we use only current liabilities, such as short-term debts. So in this case, a high cash ratio, in this case, you will have a very high cash ratio, and you will be able to pay short-term debts, but there will be a strong long-term negative impact. And this company might not be able to pay back the creditors in the long term. Okay? Now, so the company can go bankrupt if the total liabilities are near total assets. Oh yeah, and another flaw with this is that, so this is a separate one. Okay, this is a separate one. Even if a company has a lot of cash, it can still go bankrupt if total liabilities are nearly as big as the total assets, even if it has enough cash to pay the short-term liabilities. In this case, short-term creditors will still get burned. So a good example of this was the debt crisis in 2008. You had companies like big companies like Lehman Brothers, I think, which had more than enough cash to pay for all of its bond interest and bond principals within the next 12 months. But because the liabilities were so big compared to the total assets, they were sort of like strong-handed by the government. Well, it seems that way anyway. Okay, they seem to have been strong-handed by the government into declaring bankruptcy, even if they had enough cash to pay for their short-term debt. Okay, even if they had enough cash to pay for their short-term debt, they were still, in a way, forced into bankruptcy because their total liabilities were quite big compared to their total assets. Okay. Okay. Now, don't. That's just from what I remember. I'm not in any way guaranteeing the accuracy of the Lehman Brothers story. But anyway, okay. So another flaw is that a high cash ratio may give a false sense of optimism to creditors by not looking at the nature of the cash. Okay? Some companies may have a lot of cash but can lose it very quickly, or as an expression, some people say that these companies are burning cash, okay? Are burning cash. All right. So an example of this is a company with very high salaries to pay, or a lot of salaries to pay. And again, another example of this might be the crisis of, I believe it happened, was it the Ford, GM, or the big car companies in the U.S.? Was that in 2009 or 2010, I think? They were burning a lot of cash because they had very high salary, or they had a lot of salaries to pay. Okay. Now again, I'm not guaranteeing the accuracy of the facts of the story. That's just from what I remember. Okay. Now, unpaid salaries will not be reflected. Will not be reflected on the balance sheet or the income statement as liabilities. Okay? So the unpaid salaries for the rest of the year might not be considered, or are not considered, a current liability because the employee's work hasn't been performed yet. Therefore, you will not see it on the balance sheet. But you can be sure that the huge cash outflow from these salaries will definitely happen in the near term, and that can cause a company to lose a lot of cash very quickly, even if it does not have any liabilities, because technically an unpaid salary is not yet a liability, or it's not a liability until the work has been done. Okay? So in this case, even if a company has a lot of salaries to pay and is losing cash so quickly like crazy because of high salaries, you might still have a high cash ratio because the cash ratio formula does not include unpaid salaries. Okay? So what's another flaw of this ratio? A low cash ratio may give a false sense of danger. So an example, let's say that a company doesn't have much cash, but has a ready line of credit from banks anyway, meaning it has a standing agreement with banks which allows the company to borrow cash anytime it needs the cash. It can borrow money from the bank quickly and easily and almost automatically. All right. So what is the traditional analysis of the cash ratio? Well, first is you compare it to the historical cash ratios of the company. If the cash ratio is higher now than last year's, then either it is more stable or in a less risky debt situation than before, or it's more efficient now than before in managing assets or managing cash, or both of the above. Okay, when I say managing cash, that means that a company can operate properly even without much excess cash. Okay? Or both of the above. If the cash ratio is lower now than last year's, then either it's in a more risky debt situation than before, or it's more efficient now than before in managing cash. So it doesn't need much cash to operate properly. Okay. Or both of the above. Traditional analysis number 2. Compare the cash ratio to that of companies in a similar industry. If the cash ratio is higher than similar companies, then either it's in a more stable or less risky debt situation than them, or it's more inefficient than them in managing cash. That's why it needs so much excess cash to operate properly, or both of the above. If the cash ratio is lower than similar companies, then either it's in a more risky debt situation than them, or it's more efficient than them in managing cash. So it doesn't need much cash to operate properly. It doesn't need much excess cash to operate properly, or both of the above. Now I stress similar industry because some industries, such as, for example, the banking industry, need a lot of cash, much more cash compared to another industry such as, a luxury car showroom, for example. A luxury car dealer might not need so much cash because the inventory in a car dealer moves very slowly. So they just need a lot of cash to buy the cars, or no, maybe they don't even need to buy the cars. Maybe the cars are put there on consignment by the manufacturer. But a bank, of course, needs to hold a lot of cash because it's in the business of cash. So you cannot compare the cash ratio of a bank to the cash ratio of another company, which is a car showroom, for example. It wouldn't make sense. Okay, naturally the bank's cash ratio would be much higher. So if you want to compare the cash ratios of different companies, make sure they are from make sure they're from the same industry. Okay, make sure they're from the same industry or from very similar industries. Okay, so remember to share us if you like us on Twitter. Look for MBA Bullshit. Look for us on Facebook, facebook.com/MBA Bullshit, or forward my YouTube links on your email. Have a great day and goodbye.